Hi everyone, so we are Group 5 in Business Finance, and for today's video, we're going to talk about our assigned topic, summary. So the first part of this video is all about the nature and aims of business. That's pretty simple. So what is business? Well, business is an organization that provides goods or services satisfying the needs and wants in a profitable or non-profitable way. Yes, that is correct. Some businesses want to make money, and that's cool. But guess what? Even if a business is non profitable, it is still a business. Take charities, for example. They're all about helping, not making money for themselves. Okay, so why do business exist? Of course, to generate income. The main goal of almost every business is to make profits. That means they want to earn more money than they spend. So let's move on to the kinds of business. So kinds of business consist of three main divisions, which are the commerce, industry, and services. So first up, we have commerce. It refers to the exchange of goods and services between the individuals, businesses, or nations. So, commerce is like a big store where things are bought and sold, whether it's clothes, gadgets, or groceries. When we say commerce, it refers to buying and selling actions takes place, just like your favorite store or online shop, right? Now, let's talk industry. So, industry is where things are made. Industry is like a workshop bringing products to life. So, service is an intangible activity or item offered in economic value. These three kinds of business work together, creating a dynamic, interconnected world of businesses. So, business have several goals. First is the aim to provide products and services to the community. Second is satisfy personal objectives. Third is protect and enhance society's resources. And last one is ensure and effective operations. So that's all about the nature and aims of business.
Chapter 2, Organizing a Business. To sum up what Chapter 2 tackles about, organizing is the first stage of life cycle in business. It involves structuring and arranging resources, people, and processes to achieve its goal efficiently. Organizational stage is a very important aspect in the life cycle of a business because the most reason why a business fails is because of bad or improper management, inadequate marketing, poor location, failure to invest, and lack of adequate financing. Persons engage in business to enjoy certain values which are provision of employment, profits, earn a living, protection of oneself and family, personal satisfaction, service to the community, and achievement of power. To engage in business means to buy existing business and to create a business. A businessman should have a skill to choose an opening and should have a skill to pick the right business opportunity. Business promotion. This refers to discovery and exploration of a business opportunity with the purpose of converting it into a going concern. The steps in business promotion are: first is discovering the idea for a new business. Second is determining the feasibility of idea. And lastly is assembling the needed resources to start the business. There are resources needed in organizing a business, such as initial capital, essential properties, process, and personnel. Source initial capital. This refers to the initial funds or investments that are contributed or obtained to start a business. There are two main sources of capital, which are the owners and the predators. The promoter is the person responsible for the formation of a company. There are classifications of promoters, namely professional promoters, sideline promoters, banking promoters, financial promoters, and subdivision promoters. In conclusion, Organizing a business is important for several reasons, such as efficiency, clarity and focus, effective decision making, scalability and growth, and employee management.
Hello everyone, my name is Kai and today I'm going to tackle about the fundamental concepts and tools of business finance. So first, what is finance? Finance is the process of acquiring and managing funds or money to meet specific goals. It involves activities such as borrowing, lending, saving, investing, and budgeting. It's all about how individuals, businesses, and government generate and use funds to meet their economic goals. Example is, to make it simple, it's all about how you manage your money, how you earn it, how you spend it, and how you save it. And also how you invest it to grow it over time. So finance can be broken down in two categories. First one is the public finance and the second one is the private finance. So what is public finance? Public finance is all about the rule of the government in the economy. It's concerned with the income and expenditure of public authorities and how these activities influence the overall economy. This includes things like taxation, public expenditure, public debt, and fiscal policy. The main goal of public finance is to ensure the maximum social advantage, meaning the government tries to achieve a balance where public income equals public expenditure. So one of the examples of this is like SSS, PhilHealth, or Pag-ibig. Now let's move to the private finance. Private finance is all about the financial management of individuals or corporations, and it involves decision making related to investment, funding, and dividends to increase personal or corporate wealth. So, under private finance, we have personal finance, business finance, and finance of nonprofit organization. So what is personal finance? Personal finance is all about how you manage your money. It involves all the financial decisions an individual or family must make in order to earn, budget, save, and spend money over time, considering various financial risks and future life events. In short, personal finance is about making smart decisions with your money to achieve your financial goals, whether that's buying a house, retiring comfortably, or just making sure you can pay the bills each month. Now let's move to business finance. Business finance is all about how a company manages its money. It's about making smart decisions on where to get funds and how to use them effectively, whether it's for starting up, expanding, or just maintaining the daily operations. It's balancing act of maximizing profits while minimizing risk. Now let's move to finance of nonprofit organization. Nonprofit finance is all about managing the financial resources of a nonprofit organization to ensure its sustainability and ability to fulfill its mission. This can include budgeting, fundraising, financial reporting, and more. Ang goal ni non-profit organization or business of non-profit organization is not profit, but rather to effectively use resources para ma-achieve ang mission sa usa ka organization. Like for example, charity events where people will gather or will find a ways to earn that target amount para, or what we call fundraising, para mapalit nila or mabuhat nila ang ilang mission, or for example, feeding programs, or they want to have this mission where they will buy books for kids in the public schools and etc. Basta the main goal gid ni non-profit business finance of non-profit organization is not for the profit but to achieve the goals para sa ilahang mission. Okay, let's proceed to business finance has three aspects. First one is the small business. Example of that is sari-sari store. The second one is a corporation finance. So corporate finance is basically all about how businesses manage their money. It's like financial life of a company, involving decisions on what to invest in, how to fund these investments, and how to reward the shareholders. For example, let's say we have a company named Sunshine Cookies. They make delicious cookies and have been doing pretty well. Now they want to expand their business by opening a new factory. This is where corporate finance comes in. No? So let's proceed with multinational business finance. So multinational business finance again, it's the management of finance in an international business environment that is trading and making money through the exchange of foreign currency. So, ang main goals gid sa finance, guys, it focuses into three things. First one is profitability, so making as much money as possible. Second one is growth, expanding the business over time. Three is stability, it's ensuring that the business can survive in the long run. Syempre, no, kinsa may ganahan nga magnegosyo niya, dili ra di ay ma-earn sa sayang lang ang effort ng kwarta if dili na to i-goal nga mutubo o kanang mo-expand pa ang ato ang negosyo. So, let's proceed to the financial statement. Ang kanilang financial statement, guys, this is written records that convey the business activities and the financial performance of a company. There are various of financial statements, but only two of them are very important from the point of view in the business finance. So the first one is the balance sheet. Sa balance sheet, dili na to makita ang assets, liabilities, and net worth. Now, the second one is the income statement or the profit and loss statement. Dili na to makita ang revenues, expenses, and net profit or loss. So, thank you so much, guys, and see you next time.
Good day, everyone. I'm Kimberly Ann Alcala, and I'm going to summarize the chapter 4, which is the financial markets. So, financial markets is a platform that can provide a permanent venue for savers and also to the borrowers, and which can render financial services whenever required by their customers, and also these services are made possible by the financial marketers through the creation and trading of financial instruments. And the examples of financial market is the New York Stock Exchange, or the NYSE, is a financial market where stocks are able to traded. In addition, financial market is useful in two aspects. First is the fund is directed to DSUS, which can use them most efficiently or more efficiently. And second is the liquidity are provided to savers, which is more reliable. So, financial markets transfer funds directly or indirectly. So when we say direct finance, it is refers to lending by ultimate borrowers with intermediary. One of example of direct finance is issuing stocks or bonds in the financial market. So in other hand, the indirect finance or the financial intermediary, it is refers to lending by ultimate lender to financial intermediary that lends to the ultimate borrower. So one of example of indirect finance is taking out a loan from a bank. So here are some classification of financial markets. 1. Primary market. 2. Secondary market. 3. Money market. 4. Capital market. 5. Bond market. 6. Stock market. 7 is the mortgage market. 8 is the consumer credit market. 9 is the auction market. 10 is the negotiation market. 11 is the organized market, 12 is over-the-counter market, 13 is the spot market, 14 is the future markets, 15 is the option market, 16 is the foreign exchange market. So in conclusion, the financial market, it is individual and institution trade financial assets like stocks, bonds, and currency, commodities, and derivatives. And also they facilitate the buying and selling of these assets. And also it can help to manage risk, diversity, raise capital, and portfolios. And that's all. Thank you.
A pleasant morning, everyone. I am Cyril Joy P. Miago from BSBA FM 1A. Today, I am going to tackle about the Chapter 5 summary. So, capital budgeting is an important segment of business finance. It includes relevant aspects of an investment, valuation, risk, and uncertainty. So, the investment in capital budgeting is made when a firm spends some of its funds for the establishment of a project, and the valuation is the process of determining the worth of an asset or a company. In capital budgeting, both risk and uncertainty plays a significant role in decision making, as they can impact the expected cash flows and the overall success of an investment. It is important for businesses to carefully assess and manage these factors when evaluating potential project or investment. The substantial outlay of funds for the purpose of lowering costs and increasing net income for several years in the future is called capital expenditure. So, the capital expenditure in the capital budgeting is about making strategic investment decisions that will contribute to the growth and success of the business over the long term. It requires careful planning, analysis, and consideration of factors such as risk, uncertainty, and future cash flow. The planning and control of capital expenditure is called capital budgeting. When the real worth of the firms of any proposal for capital expenditure is determined, the process is called valuation. An investment happens when the firm spends more of its funds for establishment of a project. Capital budgeting is done for the following purpose: establishing properties, cash planning, construction planning, eliminating duplication, and revising plans. Let me enlighten you for the following. Establishing properties in capital budgeting involves determining which investment projects are most important and aligned with the company's strategic goals. Cash planning involves forecasting future cash flow to ensure there is enough liquidity to fund selected projects. Construction planning involves developing detailed plans for implementation for investment projects. Eliminating duplication involves reviewing and comparing similar projects to avoid unnecessary spending. Revising plans involves regular updating capital expenditure plans based on change in market condition or business priorities. Overall, these processes are essential for effective capital budgeting and ensuring that resources are allocated efficiently to achieve the company's long-term objectives. The capital budgeting system consists of the following: preparations and submission of project requests, approval of budget, request for appropriations, submissions of project, report, and post-approval reviews. The primary factors considered is evaluating proposed capital expenditure are urgently, repairs, credit, non-economic factors, investment worth, and risk involved. The economic evaluation of proposals consists of the basic methods, the payback methods, the average rate of return methods, and the discounted cash flow method.
In this chapter, we are going to tackle about working capital. So first, let's define what is working capital. Working capital is the amount of money that need in the business to produce good or service. In other words, it's amount of cash that need to operate a business day-to-day basis. Needs of working capital. First is replenishment of inventory. The company needs working capital to replenish their inventory that they sell to the customer. It includes the raw material and the finished goods. Second is the provision of operating. The company needs working capital to cover up their expenses for operation, such as utilities and salaries. Thirdly is support for credit sales, which allow customer to buy the product or service now and pay them later. Lastly is provision of safety margin. Working capital provide a safety margin in case of unexpected event happen, such as decline of sales and increase of costs. Management of working capital. First is adequate to cover all current financial statement. It means that a company should have enough working capital to cover on its day-to-day operation. Second is liquid enough to meet current obligation. It means that a company should have any other asset that easily to convert into cash to pay its bill when it comes to due. Thirdly is conserved through proper allocation and commercial use. It means that the company should use the working capital efficiently and to avoid unnecessary waste. Lastly is use to attachment of profit objective. It means that a company should use the working capital to maximize their profit. Liquidity management is the process of ensuring that the company has enough cash on hand to meet its financial obligation. Cash sale. It's a most liquid asset and it's immediately available to cover its current obligation. Collection of account receivable. It involves of collecting the payment from the customer for the goods or service that has already been delivered. Loans is a source of external financing that can be used to cover up the short-term obligation. Sales assets. It involves of selling non-essential assets. Owner contribution. It's a source of internal financing that can be used to cover up the short-term cash flows need. Advance from customer. It's a finance that is typically provided by customer to help the supplier to cover up the cost of production. Cash management. It's the process of ensuring that the company has enough cash to meet its short-term obligation. Account receivable management. It's a process of managing the account receivable to ensure that the customer pay its debt. And inventory management, it is the process of managing the inventory, which is to use the goods or raw material that has been used to produce the products.
So here are the summary of Chapter 7, Sources of Short-Term Capital. There are methods a business uses a short-term funds like bank loans or trade credit. Short-term financing is one of the three segments of business finance. The others are intermediate-term and long-term financing. Short-term credits provide advantages such as they are easier to obtain, it is often less costly, and it offers flexibility to the borrower. The disadvantages are it matures more frequently and there are times when they are more costly than the long-term debts. Short-term financing is provided by trade creditors. It is a supplier's extending credit to a buyer for use in manufacturing, processing, or selling goods for profits. Commercial banks are institutions which individuals or firms may tap as source of short-term financing. Commercial paper ranks houses is a short-term promissory note generally unsecured and which is sold through commercial dealers or directly to investors. Finance companies are those which are engaged in making short and intermediate-term installment loans to consumers. Factors of finance business receivables and finance the sale of business and forms equipment. Factors consist of the purchase of accounts receivables outright without recourse to a seller for credit losses. Insurance companies provides a stable source of short-term funds. Company accruals, an expense that has been incurred but has not been paid.
Good day, everyone. I am Cindy Sugurol and I'm going to report the Chapter H, which is the corporate stocks. So, corporate stocks are ownership shares in a company. Example, buying shares of an Apple Inc. makes you a shareholder in the company. So, the capital stocks are classified as either a common stocks or a preferred stock. So, in a common stocks, we have the classified common stock, deferred stock, voting trust certificates, guaranteed stocks, and debenture stock. Classified common stock. So, it is a customizable stock that suits the company and investors. Mura ni siya og privilege sa mga other stockholders kanang dili magkapareha ang rights sa mga stockholder sa usa ka company. Kay naay uban stockholder na mas dakog range or mas daghan og rights kaysa sa usa ka normal na stockholder. So for example, XYZ company issues Class A and Class B common stock with different voting rights. So diri sa example, makita nato na ay duha ka klase na stockholders. Nya lahi-lahi sila og rights depende kung asa sila na class na belong. The second one is deferred stock. It gives dividends and assets upon dissolution, often a bonus for founders or managers. So kani siya na klase na stock, mura ni siya og agreement o saad na makadawat ang shareholders sa ilang dividends og assets once madissolute or in other hands masirado ang company. So mas labaw pod ang madawat sa mga founders or managers since mura man ni siya og bonus. For example, founders of ABC Inc. providing them with additional benefits with the company dissolves. So, sa kaninga example, ang deferred stock kay mura jud ni siya og bonus sa mga naa sa taas kung maklose na ang usa ka kumpanya. The third one is voting trust certificates. So, it is a grants voting power to corporate trustees for a set of time. Sa usa ka corporation, kay mura sila og maghatag og privilege sa mga trustee sa company na maghatag og rights sa mga trustee na makavote. For example, XYZ Corporation issues voting trust certificates allowing trustees to vote on behalf of stockholders for 5 years. The fourth one is guaranteed stock. So, it is a stock with guaranteed dividends by another corporation often tied to property deals. So mostly kay naitabo ni kung ang usa ka corporation nipalit og shares pod sa Picas Corporation. For example, DEF Corporation guarantees dividend payments on certain stocks backed by their real estate holdings. So kanina example, supposedly ang DEF Corporation kay mura siya na konektado sa usa ka kumpanya, then kanina company kay murag nipalit og shares nila. So ang DEF Corporation mura sila og nisaad na makadawat og dividend payments gikan sa ilaha. So the last one is debenture stocks. So not a stock in the real sense, but a debt issue similar to debenture bonds. So more ni siya og fixed payment na i-issue sa usa ka company in return sa long-term debt. So for example, GHI Ltd issues debenture stocks providing investors with fixed interest payments. So there are two main types of debenture stocks. So the first one is the fixed debentures which secure by specific assets. And the second one is a floating debenture secured by a charge on the assets of the firm. So I already discussed the common stocks. So now I am going to discuss the provisions of preferred stock. So number one is company to dividend. Preferred stockholders receive fixed dividends before common stockholders. So kani siya kay mura nig assurance sa mga preferred stockholder na makadawat sila ani na amount before sa mga common stockholder. So for example, company ABC ensures that preferred stockholders get a $2 dividends per share before common stockholders. Classification of preferred stocks based on claim to dividend, which is accumulative and non-cumulative. Cumulative, it accumulates dividends even if not paid for years. So for example, if XYZ Corporation doesn't pay dividends for 2 years, cumulative preferred stockholders receive those unpaid dividends later. So sa cumulative, if wala na dawat sa mga preferred stockholders ang ilang kwarta within a year or 2, madawat gyapon ni nila before sa mga common stockholders. So, sa non-cumulative, it does not accumulate dividends. Ug dili madawat sa preferred stockholders ang ilang dividends karon na tuig, pwede na dili na ni maklaim the next years. For example, DEF, INC, non-cumulative preferred stockholders only receive dividends for the current year. So the second one is voting rights. Preferred stockholders in general do not have the right to vote. Unlike sa katong common stock nga naay mga trustee na mo represent sa mga stockholders, so sa preferred stocks, wala di right ang mga stockholders to vote. So the third one is subscription rights. In case of additional issues in stock, some preferred stockholders have the right to subscribe. So dili tanan preferred stockholders naing ani na right, maglaylahi ni siya. So forms of preferred stocks based of subscription rights, we have preemptive right and without preemptive right. So the preemptive right allows preferred stockholders maintain their ownership percentage by buying additional shares before the public. So kani siya na example, magpakita ni kani silang mga na-preemptive rights kay sila ang makasubscribe pa or makapalit pa og additional shares. For example, company LMN issues preferred stock with preemptive rights to existing shareholders. Preemptive right, preferred stockholders do not have the right to buy additional shares before the public. So without preemptive right, mao ni sila ang napakita o nagrepresent sa mga stockholders na dili na makapalit o makasubscribe og additional stocks. So for example, NOP corporations issues preferred stock without preemptive rights. So og kanina ang i-issue, meaning kay wala na rights ang stockholders na mopalit o magpuno og mga stocks under nila. Is callability. The issuing corporation has the option to buy back or redeem the preferred stock from shareholders at predetermined price. So kani siya kay ang corporation na nag-issue sa stock kay na sila right na paliton balik o i-redeem ba ang ilang preferred stock nga napalit na sa ilang stockholders based sa ilang giset na price. So the classification of preferred stocks based on callability, we have the callable and non-callable. So the fifth one is convertibility. Some preferred stocks can be converted into common shares after a certain period. So kani siya, more siya og right sa mga preferred stockholders na ma-convert into common stocks ang ilang preferred stocks. So classification of preferred stocks based on convertibility. We have a convertible and non-convertible. Convertible can be exchanged for common shares kung under ni ani na classification ng preferred stocks kay ma-convert siya into common stock. For example, UVW Corporation's convertible preferred stockholders can choose to exchange their shares for common stocks after 5 years. While in non-convertible, it cannot be exchanged for common shares. Ang ilang preferred stocks kay dili jud pwede ma-convert into common stocks. For example, XYZ Corporation's non-convertible preferred stockholders do not have the option to convert their shares. Participation preferred stocks may participate in additional dividends alongside common stock after receiving the regular dividend. So kani siya, na say right ang other preferred stockholders na mo-add og stocks or mo share og common stocks. Pero dili tanan ang naaani na ay right. So classification of preferred stocks based on participation. So we have the participating and non-participating. Participating can receive additional dividends along with common stock. So kani, mao ni ang mga preferred stockholders na makaparticipate or makashare of common stocks. For example, ABC Ltd's participating preferred stockholders receive extra dividends when the company performs exceptionally well. So in non-participating, it does not receive additional dividends beyond the regular preferred stock dividend. Kani naman sila, wala sila right na participate o mag-share of common stocks. Example na niya is DEF Corporation's non-participating preferred stockholders only receive the fixed dividend amount. The last one is classes. Classes preferred stocks can be issued in different classes, within in Class A, Class B, or Class C. So kani siya na klase sa preferred stocks kay mura siya og katong classification of common stocks. Naay lahi-lahi na classes na mabilungan ang mga stockholders. Nya naapoy lain-lain na mga privilege or rights. For example, GHI Corporation issues Class A and Class B preferred stocks, each with distinct features and benefits. So, since lain-lain man og class ang mga preferred stockholders, lahi-lahi pud ang mga classes sa mga benefits or rights na makuha nila.
Hi everyone, my name is Philip Baguio. I am from Group 5. So let's summarizing about the topic of Chapter 9, Corporate Bonds. What is corporate bonds? Corporate bonds are debt securities issued by corporations to raise capital for a variety of reasons such as to ongoing operations, mergers and acquisitions, or to expand business. When you buy a corporate bond, you are essentially lending money to the issuing company in exchange for periodic interest payment. And the return of the principal amount and the bond's maturity, these bonds typically have fixed interest rates and specific maturity dates. So, ang company may issued to corporate bonds needs like investors. Then, and if na investors, ang investors muhatag money sa corporate. Then, in order na ay profit, ang investors mag-set sila annual interest kung pila ang amount bayaran sa investors until ang ma-mature ang ilang gi-invest. If na ay investors, ang corporate mo bayad sa investors, so ma-receive ay ang kuanan na is interest rate, principal amount, and depende sa sabot nila whether semi-annually ba or annually. Let's say Company X, nag-issue siya og corporate bonds worth of 1,000 and has a fixed annual interest rate of 3%. So iya nang gisabot sa investor nga kana ra yang mahatag sa interest rate nga iyang gi corporate bonds sa investors, and a maturity period of 10 years. Examples rin ha. So sa investor A, nag-purchase siya send sa bonds nga ilang gi sabutan. So typically investor A will receive 3% of 1,000, so which is 30. And mubalik ang iyang gi-invest nga 1,000 once na maabot na ang maturity sa iyang gi-invest, which is 10 years. So that's the meaning of corporate bonds, which is ang investors at ang corporate bonds nagsabot. So instead ang kita mangutang dito sa company, ang company mangutang sa ato which is kita mga investors. Nasa uban nga kanang need sila investors is because na sila ipatukod ba nga project or na sila paliton mga materials nga ilang ipatukod sa ilang company, which is mag-extend sila ang kaan ba building like mangingana. So di lang sa ingon nga kanang ang company no kay nasa uban nga kanang mag-need sila og investors, magdepende pud sila sa ingana ba kay ingana mo guna ang mind sa business, which is kanang need sad nimo og kanang another kuan ba kwarta para sad ma-sustain ang imong mga needs sa imong company. So there are two kinds of bonds, government bonds and corporate bonds. So ang government bonds is a public bond while private, mauna ang company nga owned by a number of people. So examples sa government bonds. Example sa bonds kay issued by the Bureau of Treasury. While example sa private corporate kay mauna ang SM Mall, Virginia Food Inc., ug uban pa mga corporation nga company. Which is safer to invest? It is corporate bonds or government bonds. So based in my research, the safe jud nga ma-invest to invest kay government bonds. Kay ngano man, kay nagpaluyo man gud ana kay ang government man. So then if stable ang income sa governments, low risk ra jud ang imong ma-invest. So agency sa kuan man gud ana is government bonds kay agency sa Philippines nga maoy mo manage sa mga investma katong Bureau of Treasury. So unlike sa kanang private corporate bonds kay nay possible nga kuan siya kanang dili siya safe kay because we cannot know nga kanang ang kana siya nga corporate bond kay nay possible nga ma-bankrupt ba ang company. So kato imong gi-invest dito sa kwarta sa ilaha, nay possible nga kanang dili ka dayon madali og bayad sa kanang imong gi-invest sa ilaha. So naji possible no nga malugi ang company kay di matakabaw kung kanus ana sila mo-boom or dili ba na sila mo-boom ang ilang company. Choose wisely jud mga investors no, labi na og ma-invest ka dito sa mga company. And before that, imo jud i-check every ilahang mga certifications if legit ba jud sila nga mga kanang corporate bonds. And also kanang di ka dali-dali dayon og invest sa kanang company if kanang dili sila fix sa ilahang gipang provide sa imuha. So ikaw, what if ma-scam ka anang ang corporate bonds and then dako kay kaghatag sa imo gi-invest sa ilaha? So sayang na jud ang money nga imong gi-invest sa ilaha. Think before you invest guys kay the money is very important. And kanang if think sa nimo nga kani sang company is maka-benefit sa imuha and sure jud ka nga kanang imong gi-investment sa company. So we have ways of bond issuance, public offering, and also private placement. Public offering kay kanang mga bond nga is available to the general public for purchase whether government or corporation. While ang private placement, nara sila gi-choose nga specific nga tao nga mo invest sa corporate bonds. So, natay classes bonds by manner of participating in earnings. So, coupon bonds kay nakaset ni ang rate kung pila madawat sa investors. Then examples, bond price kay 1,000. Then coupon rate is 5%. Maturity kay 5 years. So, every year makadawat ang investors og 5% of 1,000 which is 50. Until maabot na ika 5th year, mag-5th year niya, ang 1,000 makuha na niya ika-5th year. So, mao na siya ang coupon bonds nga nakasetra ang rate kung pila madawat sa investors. So, natay register bonds pod. Ang kaning registered bond ang securities where ownership information is recorded and maintained by the issuer. So, it means ang name sa investor ang i-record, then inig kuha per year sa interest rate only kay katurang register nga name ang raang makuha, wala na ilain pa. So again, ang register bonds kay amo na siya ang securities where ownership information is recorded and maintained by the issuer. So it means ang name sa investor ang i-record din inikakuha per year sa interest rate only sa katurang registered nga name raang wala ang makakuha. So wala na ilain pa. So, income bonds are debt securities that pay interest only if the issuer income is sufficient. For example, if Company X income is efficient and baka receive si Investor A og interest every year. So, but if ang Company X, ang iyang income is unstable, may possibility dili kasi Investor A sa iyang interest kay dili man makover sa Company X. So, na possibility ba nga dili ka-receive sa Investor A. So, serial bonds, mao ni ang bonds nga naa siya specific maturity. Dini siya pareha sa ubang bonds nga longer ang maturity. Ang serial bonds, ma-mature ni siya in 2 occasion, which is semi-annual or 6 months, or annually, which is 12 months. So, maturity means when i-pay ang utang, ang utangan ani ang borrower. So which is a company nga nag-initiate to issue a bond para maka-capitalize sila sa ilang new ventures ba. So naasad gi-highlight ari nga mas advantage da sa borrower nga company or firm. Why? Kay alang-alang kay low interest rate man, pero in other hand dali ra ma-matured ang imong investment, which is semi-annual, which is ang 6 months, or ang annual, which is 12 months. Depende na ni sa issuing firm pila ang interest rate multiplied by the principal or pila imong yield nga money or gi-invest nga company money sa firm. Sinking fund bonds kay lahi pud ni siya, mura jud ka sinking fund nga bayad kada month ba. And pero dili ira ni gi-highlight ang annual payment of the debt. Mo repay sila sa ilang utang kay together and consent sa other trustee. So unsay trustee? Mao ni sila ang mga members sa board nga naay power to mandate or to control the corporation. It means dira ikaw ang palihok ani nga company, but together with trustee mura ra na siya og financial advisor, kumbaga periodic repayment kay naa man na siya time period. So in essence of my topic, so let's focus on what's the main reason. So why do companies issue corporate bonds? So companies issues corporate bonds for a variety of reasons. So such as to finance their operations, to fund expansions projects, to refinance existing debts, also to take advantage of favorable interest rates. So ang company naman makabuot kung pila yung interest nila dito sa investors. And also ang katong refinance ng existing debts, napod sila yung mga daghan pud bayron nun nga dapat nilang obligasyon nga bayran pud ba, kay pamilitan maka-invest ko sa imuha, so pwede pa man ka mabayran sa kasunod nga kanang month or kasabutan ba nato. So what have I said nga fund expansion projects, ang company pod if gina siya mutukod og lahi nga business, or also if ganahan ba siya mutukod ang ana nga building, o ma-expand o mo kan ba siya ma-expand siya sa iyang kan ba business, kanang tukuran na niyang kanang lot nga empty. So need siya og mga materials, or also kanang need siya investors. So mao na siya no ang company nga mo issue siya jud og corporate bonds. What are the benefits of investing in corporate bonds? Corporate bonds can offer a number of benefits to investors, including regular income for interest payments, potential for capital appreciation, and diversification benefits. So, regular income from interest payments kay, of course, nag-invest ka ditog money sa corporate bonds, at least gihatag nimo dito ang imong money sa imuharang principal amount. So sila ray bahala dito sa interest nga mahatag sa imuha. So mao jud ay naka-take advantage or naka-take sa benefits sa imuha. Ay at least lang ba if kato imong money kay magkaanam og katubo. So na jud na ginatawag pud nga take risk lang gapon jud. So it's either win or lose. And that would be all, and I hope you learned something from this topic. Thank you.
So let's now move on to the next chapter, which is the intermediate term financing. Borrowings with repayment schedules of between 1 and 10 years is referred to as intermediate term financing. This type of financing is a useful source, as it provides certain advantages that are not inherent to other types of financing. In conclusion, intermediate term financing serves as a valuable source of funding for businesses of various sizes, particularly those with limited access to capital markets. Its advantages, including lower costs, tax benefits, and flexibility, make it an attractive option for financing a wide range of business needs. Various sources of intermediate financing exists, including private commercial banks, finance companies, factors, insurance companies, and pre-need firms. Term loans, a specific type of intermediate financing, provide businesses with a fixed amount of funds to be repaid over a predetermined period, typically 1 to 10 years. These loans can be tailored to the specific needs of the borrower through various repayment options, such as equal principal payments, equal amortization, balloon payments, or deferred payments with a grace period. Even the government actively participates in term lending, providing financial assistance through private government financial institutions. With careful considerations of the repayment terms and available programs, businesses can effectively utilize intermediate term financing to achieve their financial goals and support their long-term growth.
Capital market, it is a marketplace where business or government can raise their money by selling stock or bonds. Institution or individual such as investor buy these securities in exchange for a share of the company's ownership.
The capital market is composed of three parts: the bond market, the mortgage market, and the stock market. The market for debt instrument of any kind is called the bond market. Trading in the bond market is primarily done over the counter. Most bonds are owned by and traded among the large financial institutions like life insurance companies, mutual funds, and pension funds. The mortgage market is that portion of the capital market which deals with loans on residential, commercial, and industrial real estate and on farmland. The stock market is that portion of the capital market where the common and preferred stocks issued by corporations are traded.
Securities are income-yielding paper traded on a stock exchange or secondary markets. The three main types of securities are fixed interest, variable interest, and others. Fixed interest consists of debentures, preferred stocks, and bonds, including all the government securities. Variable interest consists of common stocks and bonds, as well as preferred stocks with participating features. Others, like bills of exchange and assurance policies.
The primary market consists of buyers of securities which are issued and offered by the corporation for the first time. Secondary market refers to the market that deals with the resale and purchase of securities or other titles to properties or commodities. Securities may be disposed of by public offering and secondary distribution. Public offering, it is when a securities may be directed to the general public or special publics. Secondary distribution, it is when the first buyers of securities resell their interest to other parties. Primary distribution is achieved through stock exchanges or over-the-counter trading. The methods of underwriting securities consist of negotiated underwriting, competitive underwriting, commission sale, direct sales, and firm commitment basis.
Good day everyone, I am Cindy Sugrol and I'm going to report the Chapter 12, which is the securities market. So the securities market includes the trading of financial assets like stocks, bonds, and derivatives. This plays an important role in the distribution of securities. So ang securities market, kay isa siya ka financial markets wherein mapalit or mabaligya ang stocks, bonds, and derivatives. Ang ingana nga klase sa market kay usa siya ka platform sa kumpanya na maka-gain or maka-acquire sila og kapital na makatabang nila sa funding sa ilang mga operations. o para sa growth sa ilang company. So, while also providing liquidity to the investors na naghatag nila og privilege to trade securities. For example, the London Stock Exchange facilities trading in various securities. So, the London Stock Exchange, which is the LSE, stands as a prominent illustration of a securities market, playing a crucial role in the trading and distribution of a diverse array of financial instruments. It is established in 1801. The LSE has evolved into one of the world's leading stocks exchanges, attracting a vast array of domestic and international investors.
Leasing is a contractual arrangement where one party, the lessor, grants another party, the lessee, the right to use an asset for a specific period of time in exchange for periodic payments or lease rentals. Leasing is a common financing alternative to purchasing assets outright, and it can offer several advantages, including conservation of capital, and then predictable expenses since lease payments are typically fixed over the term of the lease, so which can help businesses to budget and manage their cash flows. And then aside from that is asset flexibility. So leasing provide businesses with greater flexibility in managing their assets. So leasing is a very important source of long-term financing kaya it allows businesses to conserve capital, improve cash flow, and gain access to assets that they may not be able to afford to purchase outright.
Pleasant morning, everyone. I am Cyril Joy P. Niaga from BSBA FM 1A. So today, I am going to discuss about the type of leasing. So a lease is a negotiated contract between the owner, lessor of the property, allowing the firm, the lessee, the use of the property for a specific period of time for a specific rental. So the type of lease are the financial lease, the person or company using the asset. This is used for a long-term financing of assets such as equipment, machinery, or vehicle. And the second is operating lease. The owner of the asset used for the short-term financing of assets such as office space, computer, or vehicle. The next is sale and leaseback arrangement. Is a financial transaction in which company sells an asset such as real estate or equipment. And the last is the net and gross lease. The tenant is responsible for additional expenses on top of the base rent, while in the gross net lease, the landlord covers all expenses and the tenant pays a fixed rent amount.
In conclusion, leasing attributed a certain advantages, like avoidance of risk, attached to ownership of property, flexibility, piecemeal financing, and many others. And also if there has an advantages, also there are disadvantages, like it is more costly than purchasing the asset, the benefit depreciation, investment tax, and salvage value are not availed of by the lessee, and many others. And also leasing is desirable if generate cost savings over borrowing, or if debt financing is not available, of if there is some offsetting advancement or advantage justifying high costs. That's all. Thank you.